The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So we're going to break down a lot of this economic data in terms of three sectors, as I said. The first one being price data, consumer price index, again measuring the monthly price change of a weighted basket of goods and services. Producer price index measures the average change in selling prices received by domestic producers of goods and services. And the import-export prices, MXP, and I've just put this below in terms of decreasing its importance, I suppose. It's a US figure becoming more important. Why is that? Well, it's defined by the US Bureau of Labor Statistics as containing data on changes on the prices of non-military goods and services traded between the US and the rest of the world. So why is it becoming more and more important? Well, because we see a real trade deficit. Again, this relates to the last lesson when we went through trade and capital flows. Of course, we've seen that the US is now increasing, or it cannot help its trade deficit increasing year on year due to the huge deficit it has with China and the rest of the world. So this is of particular importance to the United States. So the Consumer Price Index, CPI for short, we may have heard this, we may have traded this before. It's more or less an inflation barometer. The inflation rate is simply the percentage change in CPI. Consumer prices account for the majority of overall inflation. Inflation is important to currency valuation because rising prices lead the central bank to respond by raising interest rates to meet their policy mandate of maintaining inflation. Okay, the core inflation rate is the percentage change in the CPI less energy and food prices. The producer price index, PPI, which we'll discuss, is the corporate analog to the CPI. Okay, so the PPI index. What we see here in front is Eurozone CPI year on year against Germany, France, and Spain. Okay, so this gives us an overall level of economic performance, of nominal value or wealth that we have in each of these economies relative to one another. So more specifically, what does this chart mean? What is this chart showing us in front? Well, we see Spanish CPI there 2016 onwards to 17 really, providing difficulties for the Spanish market, of course. So when something is rising and it is at 3% here, effectively we are at a severe disadvantage. One reason as well is because we're effectively all trading in the same currency, guys. If I'm doing my groceries shopping at the weekend, I'm living in Ireland here, of course, I'm using euro. In Spain, euro, of course, using euro as well. In Germany, you're using euro, and in France, you're using euro, just what we have on chart here. So effectively, Spanish economic agents or not nominal people doing their grocery shopping are at a severe disadvantage as their level of inflation is increasing because the value of their account, the value of their capital is actually decreasing according to the rising prices of goods and services in their economy. Whereas if I'm in Ireland here, it's roughly around 2% as well. Like France and Germany, we're seeing very nominal levels here, and that's very much in line with the policy mandate for many central banks holding, their mandate to 2%, because of course we see, as more consumers and as monetary, as I suppose economies grow across the world, consumers purchase more items and consumer spending grows. Of course, you're going to see inflation rise at nominal levels. However, it should not rise too much because obviously those market participants within an economic area are at a severe disadvantage. So that is, of course, the Consumer Price Index. Now, it has very, very important manifestations in terms of interest rate changes, which we'll discuss, of course. The PPI, or Producer Price Index, is and follows a family of indexes that measures the average change over time in selling prices received by domestic producers of goods and services. In doing so, it shows the increasing or decreasing level of competition from domestic producers, thus adding to the overall increase or decrease in inflation. Okay, so that's effectively what we have. We have, again, a very, very strong structured index that we can follow in terms of gauging the level of inflation in the economy. Again, we define it, let's just go back a slide, to the corporate analog there to the CPI. So it's more focused on corporations, it's more focused on rising prices because those business owners of course selling products and services. So are the costs of the cost of us actually going out to do our groceries, is that rising? That is one equation, of course, in defining inflation. But are the costs that businesses across our nation or Europe, the larger European economic area, that they're choosing to put on their products and services to sell to a larger market, is that increasing as well? Of course, that feeds into the overall inflation story, and of course is very important as a potential figure that we look to trade in terms of defining inflation. So effectively what we see here is a pop in April. The PPI final demand year over year, seasonally adjusted. We see a pop in the PPI again again, this is the Bureau of Labour Statistics. So this is in the United Kingdom. So again, we see an April pop there just in 2017, just above 2% as well, which again, you're going to see more discussion. How do we disseminate that as traders in these asset classes again? So again, if you understand interest rates, we're going to go through interest rates quite a lot throughout this Become a Pro course. This is effectively a big sign to us as traders how we might look to position or make trades in the market. So of course, these are our nominal levels. These are our mandate levels, 2%. Okay, and we have significant touches in and around 2%. Again, we see trading downwards or trending downwards, and then effective deflation 2015. In the United Kingdom, what we see in April 2017 is a pop there. Now, if that were to happen now relatively, let's say we're at 2% levels currently, and we see a pop again up to around just under 3%. Given the context of Mark Carney's decision to hold off on interest rates currently there 1 month ago, if we see a further pop in inflation, what may he be forced to do? Obviously, he discussed in terms of forward guidance to hold off on interest rates, but if we see a further increase or a pop in inflation, of course, he is actually more inclined to increase the base interest rate, the official bank interest rate in the United Kingdom, to tackle inflation, to try and bring inflation back down to nominal levels. Okay, and that is how we can look to trade the overall story. That's how we look to properly try and disseminate economic data for our trading decisions. How will that affect sterling? Of course, it's likely to cause some bullish sentiment in sterling against the dollar or against other pairs. Consumer sector data, and then moving on, we have, of course, retail sales. Okay, what are retail sales? Well, measuring the total value of sales at retail level. Consumer credit, the change in total value of outstanding consumer credit that requires installment plans and payments. Consumer confidence or sentiment takes account of the level of business confidence in the economy. Services PMI outlines the strength of the services sector in the economy. And effectively, retail sales. Retail sales measurement is usually a month-on-month figure that measures the change in the total value of sales at the retail level. It provides insight into the flow of money in an economy and to the level of actual disposable income. Actual disposable income that us as consumers have available to spend. Why might that be important? Well, for many different reasons. In terms of economic growth, we look to the consumers to try and stimulate growth. Okay, that was one of the main focuses of monetary stimulus, to stimulate growth, to stimulate spending, to stimulate small business creation. Effectively, if we can't find a way to measure this, well, how are we able to see local businesses grow if we can't measure the retail sales or a level of disposable income circulating in the economy? It is the primary gauge of consumer spending, which in most economies accounts for the overall majority of overall economic activity. Okay, so what we have in front here is UK retail sales. Again, we see a sharp increase from 2014. That would simply suggest to us, finally, we are seeing some sustained growth. And what I mean is sustained growth. So we see nominal levels here trending sort of just over the 100 mark. We can't see lift off just as of yet, but from this moment on, we see a very, very strong increase in retail sales there in the United Kingdom. Such a strong pickup, isn't it? It's a strong pickup overall in retail sales, clear indication to the markets that the consumer sentiment is strong. It tells us, literally tells us, that there's a pickup in spending in products and services across the United Kingdom. And that is, of course, going to further stimulate the economy. So that is, of course, good news. When you can see 2010, of course, we have a very recessionary period. We can see the bar chart here outlining the volume. I'll just remove that a little second, the annotation there. We can see the volume with the bar chart as well, trading down to lower levels 2010. Effectively, we're touching around 2.2 around this level here, minus 2.2 of spending in terms of overall retail sales. Not supportive of the economy, of course, at all. Consumer credit, then, the amount of outstanding consumer credit in an economy outlines the level of overall debt standing as financial liability in the economy. Okay, so the overall, it's important to note, what is the overall liability for financial, for banks and financial organizations in our economy. And that's more and more important now, given the last recession was completely as a result of a financial crisis, a financial banking crisis. Rising debt levels are a sign that lenders feel comfortable issuing loans and that consumers are confident in their financial position. So that's comfortable, okay? At the extreme, of course, as such, extreme measures can show us the overall level of risk the domestic financial system has on its balance sheet, okay? We have some news flow, of course, here to really think about how this might affect us as traders in terms of pricing in the United States in the overall perspective of consumer credit. We have some news flow and data that can provide us with an overall confidence level of the economy. That's most certainly the case. But what if we were to get, again, a large miss in our consumer credit? What if the perspective, again, was 55? So all figures above the 50 level in consumer credit was showing positive signs of expansion. But for some reason, we got an anomaly figure that was 43, okay, below our 50 bullet point. That is going to cause severe shock to the market. That is going to be a huge shock that we can obviously look to trade. And again, we know if that figure comes from the United States, the level of consumer importance that the United States hold in terms of weighting its economy is stringently important. Okay, and again, we have the news flow: U.S. consumer borrowing up to $11.6 billion in March. It's quite a lot of money. Quite a lot circulating in terms of consumer credit, debt on credit cards. So very important. Consumer confidence, again, is very, very important. Absolutely all nations measure the level or sentiment of confidence in the function of the domestic market. One example is the European Sentix Investor Confidence. So more relatively close to home, the Eurozone Sentix Investor Confidence there. And we have it dating up to July 2017, so relatively soon, of course, in terms of recent movement. Measured on a mark of 0, above 0.0 indicates optimism, and below 0.0 indicates pessimism. This indicator of Eurozone confidence manages the views of analysts and investors to derive an overall level of business confidence. Okay, so this is effectively what we're seeing, and again, this is another economic indicator that we can look towards growth in terms of relative time. Here we have, of course, quite large figures more recently. So this would coincide with the bull rally that we had there, most certainly in the Eurozone. The Eurozone in 2010 did lag the progress of the United States, but was showing, a real, I suppose, with the first year in terms of the post-financial crisis movement, that we've seen a very, very, very strong year in terms of Eurozone confidence and Eurozone market growth. So that is, of course, here that we're effectively seeing in the chart. Nominally, small levels here 2016, but as we branch into 2017, you see January has a big pickup in confidence. Now, why might that be? We might see a large jump in share prices of many companies. We might see, quantitative easing, or discussion from Mario Draghi, there, the ECB president, say, but effectively we are very happy with the level of quantitative easing we are introducing to the markets. The stimulus has been very effective. There's a nominal pickup in terms of employment across the Eurozone. All of this economic data that we're studying today is, of course, going to lead into economic confidence. And in the Eurozone, we like to look at the Centix Investor Confidence here as a significant marker or barometer to gauge the overall confidence level in the Eurozone. And again, now we are at nominally very high levels in relation to previous results. So effectively, within this period, we're over 27% the whole time there, and confidence really starts to shift in terms of investor sentiment. Again, it's not simply a bunch of retailers or a few traders or analysts that comply with this sentiment. It's actually, the data includes a survey of 2,300 investors and analysts, which asks for a rating on the 6-month outlook for the Eurozone. So that is indicative of how quite a lot of professional analysts and investors view the overall outlook of the economy. So of course, if you're going to see a very strong figure next month, perhaps a 35 or a 40, we of course are going to trade some of these correlated assets to the upside. Let's potentially buy the Euro stocks or the German DAX or invest in the Euro. Services PMI is a leading indicator of economic health, particularly for those countries of whom the services sector are overwhelming contributors to the economy. Okay, the indicator itself is a barometer of service expansion or contraction in an economy. Above 50 signifies the added level of expansion, and below 50 represents a level of contraction. So very simply put, yeah, this is another indicator that is released quite frequently, I believe once a month there on our economic data calendars, and we're able to trade it. It does often see some bullish sentiment for the currency pairs that you like to trade. Again, what we have here in front is the GDP in relation to services PMI growth or contraction or expansion. Effectively, these are all interlinked, and that's what we're seeing when we observe the chart more relative to 2018. This is where we're at now. Isn't that great? So we see very constructive GDP overall, and we're seeing, of course, this is the Eurozone here. We're seeing, of course, the composite PM or production managers index show considerable push to the upside. That's effectively what we're getting. So it's another indicator that we can look to say, well, we have GDP, it's showing us some growth. What is the services doing again? And again, if you're I know the United Kingdom, I know Germany again are highly involved in the services sector as an overall contributor to their economies. If you're one of those nations, or if you're a trader that wants to trade your own equity index, and you know that your own country or nation has a significant level of employment and a significant level of output in the services sector, this will be significantly important for your market over one other as well. So given the strength here of the services sector in France, we can see the close correlation between output produced from services to total GDP. That's exactly what we see there. Okay. And on to business sector data. We have industrial production, the value of industrial output produced within a country during a given time. Manufacturing PMI surveys the local manufacturers within the economic area according to their perceived outlook on manufacturing growth. Durable goods, of course, is a US figure, takes account of the change in total value of new purchase orders. And construction PMI and housing price data, significantly important. And again, just a side note there with MBA, which is mortgage-backed applications, and those applications are now more important given the recovery focused on the US housing sector. Okay, So one of the downfalls, of course, led to the financial crisis was the US housing market. Of course, we're still looking at it's now a new barometer, I suppose, in terms of business cycles. It is now included in our business cycle as a barometer of growth and success, I suppose, performance of the US economy and global economy. So it's gaining more importance considering how important real estate now prices into overall wealth in the economy. So then, first with industrial production as a business sector data indicator, industrial production itself measures the change in total inflation adjusted value of output produced by manufacturers, mines, and utilities. Production reacts very quickly to ups and downs in the economy and is correlated with consumer conditions such as earnings and employment levels. Okay, when firms perform better and make more revenue, employment and wage growth tends to increase. And that is certainly what we see across many economies. Okay, when firms perform better and make more revenue, so they're making more money, of course, in terms of profit, they can pass that on to those who made the profit for them. Of course, they increase wage growth, they increase employment, they want to continue to grow and succeed. Okay, what we have here in front then is German industrial production has been difficult to predict in the last 3 years, and that's certainly the case. So this again is something we will include in our economic calendar because we can certainly trade it. This is certainly the case. We're seeing some figures like this, which are very large outliers. But again, 2017, we've seen one. And again, we're seeing nominal levels in and around our average prices or our average nominal levels of +1 and -1 in terms of industrial growth. However, when we see very strong figures here, that is a sign for us to trade. So if we're discussing, in German industrial growth, we see a figure like this, well, immediately sticking out like a sore thumb for me, the choice is to look towards the German equity market, not invest in equities or trade the price, the CFD price perhaps of those equities such as, let me see, Insurance Allianz Direct or other companies in the financial sector. I will be focused on perhaps chemical manufacturing, perhaps Daimler AG, who obviously manufacture automobiles for the global market. So I will be looking for long positions in German industrial companies as opposed to different sectors of the economy. And manufacturing PMI, again, manufacturing PMI outlines how much manufacturing firms are contributing to the economy. It is a leading indicator of economic health as business reacts quickly to these market conditions. Their purchasing managers hold perhaps the most current and relevant insight into the company's view of the economy. So this is not, again, a collection or a consortium of analysts who just want to make a view on the market. It's an inside view from those CEOs of many of the top companies in China. Of course, here we can use the example to say, well, look, this is the level of manufacturing that we are doing. This is the level of growth that we're going to see. And obviously they include a level of a gauge into overall growth in manufacturing with the PMI services and manufacturing there in China. Here for China more specifically, I mean, you can see how this may affect some markets. Of course, if you're unaware, China produces quite a lot for the global market. We have 70% of world umbrellas. In terms of dominating the US shoe market, and again, US shoes, Nike shoes, more popularly known, and they're competing with Adidas, of course, in Germany. What effect will this have on their share price? What effect on different assets, of course, in the German DAX, perhaps? If we see a huge figure changing in terms of the overall growth, we know that, well, this figure is telling us, of course, 70% of US shoes are manufactured there in China. So how do we price this in? Again, it's a total survey of over 3,000 purchasing managers, asking them to rate the level of business conditions, employment, production, inventories, and new order prices as well. So again, we can look to trade these assets considerably if we were to have a very large beat, of course, for US PMI, manufacturing PMI. Well, we're going to look to sell some of those big producers some of those big producers, perhaps Apple, were going to sell the shares of Apple or correlated assets as well. Durable goods orders as well are significantly important. What do they represent? Well, we define the durable goods orders as the total value of new purchase orders placed with manufacturers for durable goods. Forex traders often anticipate this figure as nominally strong figures can bolster the currency, leading to appreciation. Why might that be the case? Well, let us think about that logically. If we have 100 firms in the Nasdaq and they all increase the level of expenditure, perhaps in the US for some goods that they want to order, or perhaps some outside companies, and perhaps some UK companies or Chinese companies want to purchase, hundreds of thousands of Apple iPhones. They're placing large orders of iPhones. Well, then we're going to see a large value effect in demand, strong demand for those products that are denominated in, of course, US dollars. And again, to refer to the last lesson, we're going to see capital and trade flow into the US dollars as a result. Rising purchase orders signal that manufacturers will increase activity as they work to fill the orders, which may lead to further employment and growth. Okay, that's very, very straightforward. Very straightforward indeed. Of course, rising purchase orders may indicate more growth in other sectors of the economy, employment as well. Effectively, what we see and how we can trade this as well is, well, we see a stark strengthening position here for core capital goods orders in July 2017. This price here, right up to roughly around 9% there, all in a few months there, roughly in a 3-month period. So that's very, very significant, very significant. And again, we can actually look to get involved, and use our ideas as traders to make opportunities available. If we are understanding the news flow, let's say we have a company like Boeing who have made a claim that they have received a whopping order for their new Boeing 747 from some firms there out Middle East. Well, that will price into the durable goods order as well. So we can often see big jumps in this figure. And of course, if we want to trade the US dollar as such, there's going to be a decrease in the US dollar fundamentally. So often the figure can be skewed by large billion-dollar order deals. This enables many opportunistic short-term opportunities for short-term traders. So let's get involved in understanding, how this can move markets and how we can look to trade. And again, what we have to finish off with is construction output and production. Okay, construction output is quite common here across the UK and Ireland, of course. Released by the Office for National Statistics in the UK, construction output month-on-month details the change in total amount of builders spent on construction projects. It also highlights the strength in the private housing sector, given that large economies hold a large portion of their wealth and income in real estate. And this is effectively what we're seeing in the UK. We have a nominal or average level of construction PMI. When we see changes according to this, well, of course, we can look for growth or divestment opportunities as well. Particularly, construction in the UK provides considerable employment, employing over 270,000 professionals. And again, if we see this figure decline drastically quarter to quarter, well, that figure itself, the employment figure, is going to see a relative cut during that period. And again, that's going to factor in and to many different economic functions of pricing, inflation, of pricing in many of the assets, of course, we like to trade. So there are a few disadvantages to economic data, of course. In understanding a lot of the economic data, you're going to be much more sound of mind in terms of understanding why markets move and how you look to objectively think, well, the markets are moving, what asset is it going to affect the most? What markets should I trade? What rhetoric should I trade? What should I look for, perhaps within the language of a ECB press conference? If it means discussing inflation with a little light in terms of refracting or pulling back from its 2% target, I know that's going to have a nominal effect on the bonds, the European bonds, and obviously pricing the currencies. But there are, of course, many disadvantages just generally to economic data. Using measures of economic growth can give distorted views of the level of income in a country, as income distribution is not taken into account. Economic data released to the market does not often represent real movements in the economy, and you can see the difference between some of the forecasts from analysts in terms of real relative moves in the economy when those forecasts are effectively a beat or a miss. A formal commission headed by Stanford economist Michael Boskin in 1996 determined that, in fact, the CPI overestimates by as much as 2.4% per year. Okay, so that may be the case. You know, how does this affect us? How does it affect our lives, of course, in terms of the real inflation move across that currency? So that might be the case. However, what I would focus on, if 2.4% is, or sorry, if the inflation figure is released to the market, the real inflation rate, of course, trade what you see and not what you think in terms of how it affects your own capital in your own account. You know, we're more focused on trading the markets, as opposed, there's nothing we can do in terms of avoiding inflation nominal rates, I suppose. One thing I would argue is there is, of course, one thing we can do: trade the financial markets, get involved in trying to outperform inflation. That is certainly our objective. And markets are often irrational when pricing in economic data. That's certainly the case. You may see something like non-farm payrolls come out very, very supportive of the US economy, yet the market absolutely tanks. Why is that the case? Again, it's just due to irrationality. It may be down to, of course, properly trying to disseminate that news. If there's very strong economic news for growth in the US economy, well, that might lead anticipations or expectations to forecast further or increased rapid interest rate increases, and of course we'll see a decline in equity prices. So there are some disadvantages to economic data, but again, I'd like to focus in on the economic data that we went through during the course. It's a lot to take in. You have the opportunity now, of course, to revise all of this data in your members login area. With the video here, you can go through, and of course, what I'd like to do then is thank you very much for joining us. We'll see you next time. Bye for now.